my loves, welcome back to my channel. Welcome back to the Ricky Report. My name is Ricky, and today we are going to discuss the very interesting topic of fractional reserve banking. So, fractional reserve banking, what is it exactly? Just a banking system. There are several. So they only keep a fraction, as the name suggests, of the money that you deposit in the bank. So if you think about how banks work, how they make money, what they do is they get deposits from customers and they loan the money out to other customers. So if you are lucky enough to have a large balance at a bank and you go into the bank, you just walk in and you try to make a large withdrawal, usually they're not going to give it to you. They're going to tell you have to come in and you have to order it, because they don't have that much cash on hand. And that's for literally every bank that you go to, whether it's the big banks, the big national banks, or your small local banks, or like a credit union. They don't keep that much cash on hand, one, for security reasons, and two, because they loan out your money to other customers to make more money. That's how they make their money. So, but obviously they're not allowed to just loan everything out, because if every time they get $100, they give out $100, when you come to try to make a withdrawal, there's not going to be any money on hand. So the banks are typically required to keep a certain percentage, a certain fraction of their deposits on hand, and that's called their reserves. So if you know anything about the United States monetary systems, we have something called the Federal Reserve, and some people love them, some people hate them. I'm somewhere in the middle. I don't really feel strongly either way. But the Federal Reserve here in America is the regulatory body that tells banks basically how much money they're supposed to keep in their reserve, and it's basically in America where the bank's reserves are stored. The specific percentage that banks are required to keep is called the reserve requirement. So if you really listen to these words, they start to make sense. And that is, of course, set by our Federal Reserve here in the United States as well. And usually it's around 10%. So here in the United States, typically for every $100 that a bank receives in deposits, they're required to keep at least $10 in their reserves. So being here in America, the Federal Reserve is our central bank, and they use the banking reserves as like a monetary policy tool. So they use it to basically control the economy, to get the economy going in the way that they want it to. So let's say they use the reserve requirement, right? The amount of money that the banks are required to keep on hand. If they decrease the reserve requirement, so let's say it goes from 10% down to 5%. So if they decrease it, that means they're going to increase the money supply. What does that mean? So when they decrease the amount of money the banks are required to keep, they're increasing the amount of money that the banks are allowed to loan. So now instead of being more conservative, banks are able to loan out more money, which could be good for the economy, because it can, be really good for people trying to buy homes, entrepreneurs that need capital for their businesses, and that could be a good thing. However, when they're trying to tighten monetary policy, they can increase the reserve requirement. So what that means is if the reserve requirement goes from 10% to like 15%, then banks don't have the capital to loan out to people anymore. So it tightens. It takes money out of the economy. I hope that makes sense. I'm explaining it in a way that you can understand. That is all I have for today. That is the topic of fractional reserve banking. Let me know if you guys have any questions. I will be more than happy to answer them down below. That is it. Don't forget to like, comment, and subscribe, and have a good day.